영상이 시작되기 전에 먼저 등장할 5개의 문장을 보여드릴게요. 빈칸에 들어갈 표현을 유추해보세요. 단어 하나하나를 직역하지 않고 전체 의미에 맞게 의역하고자 노력합니다. 그게 바로 영어식 사고의 출발이에요. 그럼 시작해볼까요?
Let's get into the hard facts. The first one is what's called the valuation discount. When that happens often, it drains liquidity. It makes London less competitive. There are parallels.
Welcome to the magic of listening. We're here to help you build consistent English listening habits, especially if you're interested in the world of business and economics. Today, we're looking at something quite striking, a major financial shift. We're digging into the collapse of the London IPO market. And we want to see what other global financial hubs, maybe particularly the Korean market, can learn from London's recent struggles. You know, London, for ages, it was the symbol of global finance. But now, it's having real trouble attracting new companies to list publicly. Okay, so let's get into the hard facts. What does this decline actually look like?
Well, the statistics really paint a picture, a quiet warning perhaps. If you go back to 2006, London saw over $50 billion raised through IPOs. That's initial public offerings, when a company first lists shares for the public.
50 billion, okay.
Exactly. Now jump to the first half of 2025. It recorded the worst performance for IPOs since 1998. And it's not just the money raised, the actual number of companies listed on the exchange. That's fallen by about 40% since 2008.
40%. Wow, that's staggering. So London's not even in the global top 20 now for new listings.
That's right, outside the top 20.
So this tells us it's more than just, markets going up and down. It feels deeper, like a real loss of confidence, maybe.
Yeah.
A loss of capital flow. What were the long-term things pushing companies and investors away?
Yeah, the sources point to a few big structural issues that sort of chipped away at London's appeal over time. The first one, and maybe the most critical, is what's called the valuation discount.
Okay, what's that exactly?
It means British companies, when listed, consistently trade at a lower value compared to similar companies globally. We're talking roughly 30 to 35% cheaper.
Cheaper, exactly. Which sounds good, maybe, but it makes them prime targets for takeovers. Foreign companies can buy them up easily. And when that happens often, it drains liquidity and, the ease of buying and selling shares right out of the market. Ah, I see. So it becomes a negative cycle. Companies get bought cheap, so fewer new companies want to list there because they know they'll probably be undervalued too.
Precisely. That's the feedback loop. Then the second big driver was investor behavior. Major UK investors, like pension funds and asset managers, significantly cut back on holding UK stocks.
Really? Why?
They started investing more overseas, looking for better returns. And when your big local institutions pull back, it really weakens the foundation for new IPOs. You lose that stable, long-term capital. And the third factor was the regulatory side. London has, relatively heavy regulations. And specifically, there's a 0.5% stamp duty tax on buying shares.
Hold on, 0.5%. Does that small amount really push major investors away from a global hub? Or is that just sort of an easy thing to blame?
It sounds small, I know. But think about the scale. For big institutions trading billions, that 0.5% adds up significantly. It creates friction. When you compare it to places like New York or Singapore with lower costs or no such tax, it just makes London less competitive, especially when combined with other regulatory hurdles. Every little bit counts at that level.
Okay, fair enough. Cumulative effect. So did this show up in actual decisions? Like, did any big names vote with their feet?
Absolutely. And the classic example everyone points to is ARM Holdings, a huge homegrown UK tech success story. In 2023, they decided to list their shares, but not in London. They went to New York.
Ouch. That must have sent a message.
It really did. It sort of confirmed the feeling that right now, the better valuations, the better global visibility, it's seen as being elsewhere, mainly the U.S.
Right. So if we connect this back to our listeners, maybe thinking about the Korean market, you can see some maybe similar warning signs, especially around this idea of valuation and trust.
That's the crucial link, I think. Korea faces its own valuation challenge, often called the Korea discount. Korean stocks also tend to trade below what you'd expect compared to global peers.
So a similar problem to London's valuation discount.
Exactly. It might stem from different specific reasons, maybe corporate governance concerns, geopolitical factors, but the outcome, that persistent undervaluation, is a shared challenge. It reflects underlying issues about trust and perceived risk.
And what about the investors? Is the structure similar too?
There are parallels. Korean IPOs often see a huge surge in demand right at the start, lots of excitement, but quite often the share prices struggle to hold up after listing.
Why is that?
Well, the market tends to be heavily influenced by retail investors, individuals who might be looking for quick, short-term gains. There's often less participation from the big institutional investors, the pension funds, the asset managers who provide more stability and take a longer view. That focus on sort of quick flips can lead to more volatility.
So a lot of initial hype, but maybe not enough long-term belief.
You can put it that way. Regulators in Korea are working on things like improving disclosure rules and trying to encourage more institutional money. But the real challenge might be cultural. It's about shifting the mindset, seeing an IPO not just as an exit strategy or a quick profit, but as a commitment to long-term growth in the public market.
That makes sense. London's situation is a stark reminder then. It shows that once that kind of market confidence erodes, it's really hard to turn things around. It can become a self-reinforcing decline.
Exactly. Global financial centers don't just thrive on rules and regulations alone. It really comes down to trust. Trust from companies that they'll get a fair valuation, trust from investors that it's a stable and transparent market. When your own local companies and investors start looking elsewhere, well, the momentum can shift very quickly.
A powerful lesson. So for you listening, thinking about this.
London's experience really underscores how difficult it is to rebuild market confidence once it's damaged. So considering the Korean context we discussed, here's something to think about. Which part of that necessary cultural shift, improving corporate transparency and governance, or maybe shifting the focus away from short-term retail trading, which of those do you think will be the bigger hurdle for the Korean market to overcome?
영어와 시사 경제 두 마리 토끼를 한 번에 잡는 알찬 시간 되셨다면 구독과 좋아요를 꾹 눌러주세요. 감사합니다.